Hi everybody, this is Steve Elwell from Level Financial Advisors, and this is your fourth quarter 2022 market recap. The fourth quarter provided a nice rebound for the stock market and the bond market and international stocks. After three straight quarters of downward motion for the markets, there was a bit of a bounce back. Now the stock market still has a ways to go to fully recover, but it is nice and encouraging to see the markets bounce back a little bit here for the fourth quarter. U.S. stocks were up about 7%. International stocks were up about 16%. And emerging market stocks were up close to 10%, with global real estate up about 7%. The bond market rebounded a couple of percent as well. So not a bad quarter at all. Very encouraging to see the markets sort of turn around a little bit. International stocks doing particularly well as the U.S. dollar weakened over the quarter, which helps juice the returns for international stocks. When we look at specific stock categories within the U.S. market at least, the market was really led by value stocks, both large and small. And this has been a theme that's kind of continued throughout the entire year for 2022. Growth stocks finally this particular year cooled off and retreated actually to fairly a large degree for the year. And value stocks, on the other hand, are now what I would call in vogue as interest rates have gone up, inflation has gone up. And so value stocks have really started to outperform this particular year. One of the larger spreads in returns between value and stock and growth stocks we've seen in a long time. It's quite a reversal. And, not typically, not something that's been unheard of. Markets can turn sort of on a dime, really at any given time. And growth stocks have had such a run through 2018 and 19 and 20 and 21 that it's not shocking to, sort of see them come back down to earth, particularly now that it appears the era of basically free money when it comes to capital is gone, since interest rates ended the year around 4.25%. When they started the year at effectively zero. So in the international stock market, same story. Value stocks really led the way. Like I said, it was a good quarter for the fourth quarter for international stocks as a result of the U.S. dollar weakening, the euro strengthened, so that was helpful for international stocks. And then emerging market stocks, same sort of story. Value leading the way for this quarter, and the currency depreciation for the U.S. again being helpful for emerging market stocks. So we were happy to see that played out well for how our portfolios are structured. What I would call a bit of a reversion to the mean based on how the last couple of years before 2022 had played out. Now, of course, one of the biggest themes throughout the year has been inflation. It's the reason why interest rates have gone from 0 to 4.25%, because the Federal Reserve is aggressively trying to, the Federal Board of Governors aggressively trying to fight this high inflation, which peaked, according to this JP Morgan chart here on the far right, depending on which measure of inflation you're looking at. But headline inflation, the blue line here, peaked at close to 9% earlier in 2022 and has since cooled off. It was 7.8% in October, 7.1% in November, and cooled off further in December. And the markets were certainly encouraged by the first real indications of inflation coming down, partially because I think what they're digesting and predicting is that this is going to give the Federal Reserve the ability to sort of decide to maybe at least slow down the pace of raising interest rates, if not stop altogether as we get into 2023. Because obviously interest rates going up causes things to become more expensive, like borrowing to buy a car or a house, or credit card interest rates or personal loans. And so if interest rates are higher, people can't buy as much stuff. And so the markets were encouraged by these inflation reports. The markets were encouraged by the GDP report for the third quarter, which came in good at 3.2%. That was good. The job market continues to hum along. I mean, everybody is expecting the job market to start showing lower numbers or negative numbers, job losses, and it just hasn't showed up. I mean, the job market added 263 jobs in November, had another good report in December. So good inflation number, not good inflation numbers, but getting better inflation numbers, good GDP numbers, good job numbers. That's all new information that the market digested and determined, you know what, it's possible that stock prices have baked in an expectation that's too negative, too pessimistic. And so that's part of the reason, I'm sure, why the stock market and bond markets recovered some ground in the fourth quarter. So speaking of, these predictions of a slowdown, where it's just a nonstop barrage of pundits on TV and articles in the papers and on websites saying, a recession is coming, and this might be the most expected, predicted recession that might have ever arrived. It seems everybody and their brother is predicting a recession. But I got to tell you, two of the biggest, reports that the National Bureau of Economic Research, which is the group that technically calls recessions, look at are the GDP reports and the job reports. We had negative GDP reports in the first quarter and second quarter of 2022, but third quarter looked good. Fourth quarter so far is looking okay. We don't have that report yet. And the job market has just hummed along just fine, if not above expected. These are going to have to change in a pretty major way if they're going to call a recession here. So I'm not trying to make a prediction, but if everybody's predicting a recession, these numbers are going to have to change. Interestingly, I think part of the reason that the stock market has already declined, or did decline, in 2022, or at least the first three quarters of 2022, is because the market itself was predicting a slowdown, given what the Federal Reserve said they were about to do, and then ultimately did do, which was raise interest rates from 0 to 4.25% in the span of like 10 months, which was a breakneck speed for raising interest rates. But the stock market itself, I mean, let's remember what happens with the stock market. The stock market is an information digesting machine. And what I mean by that is every new piece of information that comes out, when it comes out, gets reflected in the prices of stocks and the market as a whole. And so that information machine turns out to be extremely accurate when it comes to determining turning points for different things. One of the most obvious was during 2020 with COVID cases. Unbelievably, the stock market did a great job of predicting when waves were starting and ending. It was very, very impressive. But even more impressive over a longer period of time, as this JP Morgan chart shows on recessions, unemployment rates, and stock market inflection points, is the stock market's ability to predict in time when a recession may end. Now keep in mind, let me give clarity on what happens with recessions. When they start, generally, we don't know we're in one. When they end, there is no bell that is rung, generally. And even when we officially find out that a recession has started, is often after the fact. So, for instance, what I'm really saying is, if NBER, the National Bureau of Economic Research, comes out in a couple of months and says, oh yeah, we started a recession, they're not going to say we started a recession today. They're going to say we started a recession as of March of 2022. And that will be all over the news. Everybody will report, oh my goodness, NBER comes out, says technically we're in a recession. We knew it was coming. Oh my goodness, it's here, it's happened. But wait a minute, they're telling us that it started a long time ago. that doesn't happen to be particularly useful information from an investment perspective if the stock market had already declined 15, 20, 25%, like it did at its bottom. And these charts are kind of telling that story. So let me break these charts down for you. Particularly, let's look at probably the best one is the bottom row, middle column, December 2007 to June 2009. So the gray shaded area is the time frame of when we were in a recession. So that's a pretty long one compared to the other boxes. And we know that. That was, the great financial recession when, the banks were all struggling and the housing market was struggling. So we all remember that one pretty vividly. The purple line is the unemployment rate. So you can see how that, as the recession went on and on and on, the unemployment rate got higher and higher. The green line is the S&P 500's total return, and the black line is the market low for the S&P 500. So what I'm trying to show, or what they're trying to show on these charts, is if you look at the gray shaded boxes of when the recessions were, and you look at the market's low, in a lot of cases, the market low is in before the recession actually ends. So the market is able to predict, in most of these cases, has predicted that this recession is coming to an end before it actually did. 2020 is such a unique scenario, we're going to kind of ignore that box. But let's walk through each of them, all the way from the top left. April 1960, the stock market low was on the back half of that recession. Only a few months later, the recession ended. December 1969, that market low came in again, 4 to 5 months before the recession ended. Same story in 73. Stock market low was a little early in January 1980. But July 1981, stock market low came in a couple of months before the recession ended. 1990 is, a little shorter, more narrow. March 2001 is an outlier, right? So we've got a scenario where the stock market low came quite a bit later than what happened, that ultimately when the recession ended. Although one thing that I suppose I would say about that particular time frame is that, obviously, that time frame we're talking March 2001 to November 2001. September of that year we had a pretty big event, obviously, when you talk about what happened with the World Trade Towers. All right, there might be some reasonable assumptions that case could be different because of that. But again, the one that I was pointing out to begin with, December 2007 through June 2009, which was a long, deep recession that was very difficult for a lot of people. Unemployment rate got up to almost 10%, which is extremely high. But the market nailed it. I mean, the market bottom was February 2009, and a few months later, recession was over. But the information that comes from Enber when they call the beginning and the end of a recession is just useless. Well, the market's already figured it out. It's already moved on from the bottom. So we have another graphic from DFA that's kind of similar to the one from JP Morgan. But the general gist is that the stock markets do not wait for official announcements, which is really the point that I'm making. Even if we are in a recession right now, or already were in a recession and are starting to recover already, by time it's announced, you're too late investment-wise. If you're trying to make a portfolio change once they technically announce that we are in a recession, you are too late. And that's what markets do. They're forward-looking. They're trying to sniff out what is actually happening. And as it turns out, with all the information that the stock market and bond market digests every single day, it's a pretty good mechanism to figure out what's happening. Prices are indicative of what is happening. Are they perfect? No. Are they really, really good, better than any one individual may ever be able to make prediction-wise? Definitely. There's really no question about that. And same story. If you're going to wait when it comes to an announcement that a recession has ended, you are going to be too late from an investment standpoint to catch an upturn. The upturn will have already started. So, with the start of the new year here, and just like I said, these predictions all over the place about a recession, just coming from every direction. It makes me, as Chief Investment Officer, a little nervous when everybody agrees what's about to happen, particularly when we're talking about in the short term, because that's just not how the investment markets work. That's not how the economy works. Things are, new information results in adjustments to prices to be reflected in. And if you think that, seeing on the news, on, the nightly news that Enber calls we're in a recession is going to be some piece of useful investment information, all the data and charts indicate that information will have already been baked in a long time ago. So, we just wanted to sort of highlight how past recessions and markets have reacted for when the timing of when they're officially called and when they're officially, called to be ending or over. So we wanted to walk through all that. So hopefully that provides some useful context from an investment, or at least from a expectation standpoint. If we end up hearing that, oh yes, technically in 2022 we entered a recession. The other things that we would like to point out, right at the end of December, Congress passed a big spending bill, and that spending bill attached a couple of retirement law changes to it that do affect some of our clients. Elise Murphy did a wonderful YouTube presentation that we posted on the website and sent out that everybody can check out. It's nice and short. I think it's under 10 minutes if I remember right. That goes over the specifics of some of the different things that changed. But from a very high level, people don't have to start required distributions until age 73 now. It previously was 72. And just a few years ago, it was 70 and a half. So we're getting a delayed timeline there for required distributions. It will change again in 2033 to be 75. So Congress is giving you more time to allow IRAs and 401ks to continue to grow before you have to start required distributions. There are also higher limits for IRA contributions and 401k contributions, along with a couple of tweaks to the rules for qualified charitable distributions from IRAs and for 529 plans, some new distribution options that might be attractive for kids that are done with school and have money left over in a 529 plan. So feel free to hit our website and check out that video that Elise did for more specific details on what changed within those rules. And then lastly, over the next few weeks and months here, we'll be sending out all the tax information as it comes to us. And if anybody has any questions or needs anything that's tax related, obviously give our office a call or shoot your advisor an email, and we'll be happy to help. So with that, this is the fourth quarter 2022 market recap, and we look forward to talking to you next quarter.